What causes market crashes? In this video, we'll look at 5 types of crash which have occurred in the past. Hopefully that'll let you draw analogies with what's going on right now. And the goal is not to scare you. The goal is to make you realize that these crashes are helpful and they provide us with better entry points into the equity market. These are sales that we're talking about. So let's look at the history of market crashes in a bit more detail. Let's start off by looking at 2 asset bubbles. And the first one is the dot-com bubble. This is Robert Shiller's cyclically adjusted price to earnings ratio, or CAPE ratio. And what that measures is the number of dollars people are willing to pay for every dollar of earnings generated by the S&P over the previous business cycle, which is 10 years. So when the value of CAPE is high, that means that equity is expensive. And when it's low, equity is relatively cheap. And it's notable that the CAPE ratio picked up the dot-com bubble particularly well. You can see that CAPE reached an all-time high around the year 2000. But what's interesting is that the run-up to that peak level happened fairly quickly, and it really started off with the launch of the Netscape browser. That was the precursor of things like Internet Explorer and Safari and Chrome. And over the 6 years after Netscape was launched, that's when the equity market really took off, and then valuations peaked roughly 6 years after that. But CAPE isn't the only valuation measure which is useful. I personally find the forward price to earnings ratio for the S&P really useful as well, because that factors all available information based on bottom-up earnings forecasts for individual stocks. And this is a forward-looking measure, whereas CAPE looks back over the previous 10 years. But what you can see above me is that the dot-com bubble peak for the price to earnings ratio was very high. It was about 24 times. And that was much higher than the average price to earnings multiple, which was around 16 at the time. So what these multiples tell you is that the market's cheap or expensive, but they don't tell you when the bubble is going to pop or if it's going to pop. I think they're much more useful at the other extreme when equity markets are cheap. For example, in 2008, the forward price to earnings multiple for the S&P reached levels of around 8. So then it was very cheap indeed. And of course, that would have been a great buying opportunity. Another way to look at that is to say that the average growth of the equity market in the US above the rate of inflation, once you reinvest dividends, is 7%. And that's the red line which you can see in this panel. But notice that there are big fluctuations around that average growth line. And what you can see in this panel is the ratio of the S&P 500 relative to that long-term trend. Sometimes it's above the trend level, which means it's red in this graph, and sometimes it's below the trend, which means it's blue in this graph. And during the time of the dot-com bubble, you can see it was very clearly red. The S&P had been growing very quickly, in fact far above that 7% trend growth rate. So I think that's just another indicator to look at, which is sometimes interesting. Now what's notoriously difficult is that when you're in a bubble, it's almost impossible to tell. That's because people weave all kinds of narratives about why it's okay for valuations to be very high. Currently, people are saying it's because interest rates are very low, or that there's no alternative for good investments, the Tina rally. But certainly by April 2000, you can see this story on the BBC website, which is suggesting that the dot-com bubble was finally starting to pop and people knew about it. And what really characterized that bubble was that many of the companies which rallied massively had almost no earnings or even were burning money and had a loss-making business. And you can see that Julian Robertson, who is running the Tiger hedge fund, which was a very successful hedge fund, shut down the fund because he said he couldn't understand markets anymore. And sure enough, just like we have laws of physics, we have laws of finance, and if a company's burning money and generating no revenue, then eventually it'll go bankrupt, as happened to Boo.com, which was an online clothes retailer. Now the company itself was very innovative. It would take clothes and project them onto a 3D model, but the problem at the time was that people were using 56k modems to dial into the internet, and the bandwidth just wasn't sufficient for these 3D models. So there were lots of interface issues, plus they spent a huge amount of money on marketing and expanding very quickly with no control over their expenditure. So they probably could have made it if they'd been a bit more frugal, but in the event they didn't, along with many other internet companies which simply weren't profitable. Now, at the time, people would always talk about something called burn rate. That's how quickly a company is burning the cash which it's generated from fundraising. And Boo.com's burn rate was spectacular. It managed to burn through $135 million in the space of just 1.5 years. Well, you might be thinking, are we in a bubble now? Certainly the forward price to earnings ratio for the S&P is very high. It's been bobbing around at between 21 times and 23 times forward earnings after the pandemic rally. So it's certainly not cheap, but that doesn't mean that it's about to pop. As I say, valuation doesn't tell you when the bubble's going to pop. It's more useful once the bubble does pop and you're looking for a reasonable entry point. Our second bubble example is a US credit bubble. The IMF has produced this nice timeline showing how there was huge innovation in the US mortgage market. The fundamental problem is, how do you get capital from investors to homeowners? Now, a really simple way to do that is to package up mortgages, pools of mortgages, into something called a mortgage-backed security, which is a bond securitized by those mortgages. That means that the individual mortgage payments, which people like you and I make, are funneled into these bonds and then distributed to the bondholders in the form of bond coupons. So the classic structure for that is called a mortgage-backed security, and that was first created around 1970. But if you can use cash flows from mortgages to create bonds, well, why not other assets like credit cards or boat loans? Well, those are called asset-backed securities, and they're just an extension of the idea behind a mortgage-backed security. And it's a way of marrying up investors in the bond market with companies that need capital. But what if those mortgages are too risky? Is it possible to take those mortgages and make something that's safe out of fundamentally unsafe assets? Well, yes, it is, and that's called a collateralized debt obligation. And that's done by taking many of these mortgage-backed securities and splitting it up into tranches. So if defaults start on the structure, the first tranche takes the first hit, then you have another tranche above that, which is safer because it's protected by the lower tranches, which are subordinated to it. Now, for the riskiest tranche at the bottom, you'll get the biggest coupon, and that's because you're taking the greatest risk. Whereas for the senior tranches, you're taking a low risk and you get a low income. Now, by the time we got to 2005 and 2006, yields were very low on US Treasuries. So the hunger for yield is what drove more innovation in these CDO products. So the companies that were feeding mortgages into this CDO machine just couldn't get the mortgages in fast enough, and the credit quality of those loans suffered severely. And if you look at the rate of issuance of those subprime mortgages, it increased massively in 2003, 2004 and 2005, such that by the time we got to 2006, about a fifth of all mortgages which were originated were subprime mortgages. Another sign that there's a problem is usually complexity. The graphic that you can see beside me is for a CDO squared. You now package those packages into another package, which is the CDO squared. So that's a CDO which contains CDOs, which themselves contain mortgages. Now, whenever you see financial engineering which is this complex and where you need a PhD in mathematics to understand it, you should be thinking, this is probably a bubble. And if we compare the sell-off in corporate bonds in the US, which were obviously affected by the credit crisis, with the sell-off in the S&P 500, you can see that the two happened at roughly the same time. So the highest credit quality bonds, which are AAA, didn't fall by much relative to their peak before the credit crisis really kicked off. But if you look at sub-investment grade bonds, which are BB, you can see they lost about 25% of their value at the peak of the credit crisis. But the market which sold off much more, of course, was the equity market, which fell by about 50% at the worst point of the crisis. So credit should certainly be on your radar if you're an equity investor, because when a credit bubble pops, it definitely affects the equity market. A much less predictable source of crashes is politics. And if we go back to the Cape measure, you can see that it fell very sharply during this triple blow of three political events in the early 70s. The first one of the three blows was the end of the Bretton Woods system. Now, between 1944, when Bretton Woods was drawn up, and 1973, currency exchange rates between major countries were fixed relative to the dollar, and the dollar itself was fixed relative to the price of gold at $35 an ounce. Now the problem was that the US was running out of gold to back its currency, and there were a host of economic problems in the early 70s, such as gradually rising inflation and deteriorating balance of trade. So there was a lot of pressure to end Bretton Woods, and eventually in March 1973, the agreement fell apart. As a consequence of that, but also other factors, inflation spiked, and at the same time, the value of gold increased massively once it was taken off this peg to the dollar. The situation with inflation grew worse in the United States as the price of oil surged. That was a consequence of the Yom Kippur War, and during that war, Israel was simultaneously attacked by two countries, Egypt and Syria, which were trying to recapture land which had been taken by Israel during the 1967 Six-Day War. Now, Israel quickly repelled that invasion and pushed back deep into Egyptian and Syrian territory, but as retaliation, Middle Eastern countries raised the price of oil very sharply by 17% and imposed an oil embargo on the United States, which was heavily dependent on oil imports. The third political problem was Nixon's Watergate scandal, and this occurred when there was a break-in to a Democratic Party office in the Watergate office complex, hence the name of the scandal. But what was particularly scandalous was that Nixon lied about this to Congress and tried to cover up the break-in. And eventually this scandal led to his resignation in 1974. On August the 8th. So the problem with these political scandals is that they are unpredictable, but they also tend to come in clusters because they're often related to one another indirectly. And in the wake of this triple blow, inflation spiked in the US and stayed high for a long period of time, which was a drag on asset class returns for many years. Next, we'll think about natural disasters. Now, most natural disasters are localized. Something like a hurricane usually only affects one country or one region. In order to create a global sell-off, you need to reduce the earnings of companies all over the world at roughly the same time. Now, clearly, recently what we've experienced is the pandemic in 2020 and 2021, and that ticked all of those boxes. It was global. It affected almost all countries simultaneously, and it affected earnings all across the world for almost every company. Now, this is the announcement from the World Health Organization that said it was a pandemic, and that was given on 11th of March 2020. But one characteristic of natural disasters is their effect tends to be short-lived. So you can hardly see the downswing of the CAPE measure on this graph, although it did occur. You can see that CAPE fell from above 30 just before the pandemic to a value of roughly 25 times. Now, one of the reasons for that was that vaccines were very quickly created, and the vertical line you can see here, the dashed one, is the Pfizer and BioNTech announcement that they had an effective vaccine. And of course, after that announcement, we've seen the CAPE value shoot back up to levels which are far higher than they were before the pandemic. If we zoom in on the period after 2020, the World Health Organization noticed COVID just before the beginning of 2020, and that's this dashed red line. And then a couple of months later, markets realized it was going to be a global pandemic, and the S&P fell very sharply. But then once the Federal Reserve stepped in to save the corporate bond market and also to stimulate the economy, markets turned around very quickly. Then we had this huge rally to where we were before the crisis. Then we got the Pfizer-BioNTech announcement about the vaccine, and markets just kept on powering upwards. Such valuations now are very high indeed. If we break it down by sector and look at how much each of the sectors in the US fell going into that crisis, you can see that consumer staples, which is usually a kind of safe sector, fell least, only by 25%. And if we look at the upswing in the sectors, which is the right-hand panel, consumer staples is the one that's bounced back the least, only by 44%. Now, energy was the sector that fell the most. It fell by 57% going into the crisis, and it's also the sector which has bounced back the most, by over 120%. So generally, if you do get one of these crises and you're trying to decide which sectors to buy, usually if you buy the one which has fallen the most, that'll be the one that bounces back the most. Bankruptcies and financial scandals can also trigger market crashes. So the bankruptcy of two big companies, Enron and WorldCom, could arguably be said to be the trigger for the dot-com bubble to burst. Now, Enron was a big energy company and it had billions in debt, and it managed to hide that debt via various accounting techniques such as off-balance sheet vehicles, which are called special purpose vehicles, complex financial structures, and deals which were described as being so bewildering that few people could understand them. Eventually, those accounting irregularities came to light and the company filed for bankruptcy in 2001. And then in the middle of the next year, 2002, WorldCom, which was an even bigger company, also filed for bankruptcy. And the story was quite similar. The incentive structures for senior management meant that if the share price increased, it would massively increase their personal wealth. Again, it was a case of fraudulent accounting practices, which really shouldn't happen. All of these companies which are registered on an exchange have to have their accounts audited by independent accountants. So any irregularities should come to light in those audits. So what people were worried about was that those audits were worthless. If they failed to find accounting irregularities on this scale, then the question was what other companies were hiding irregularities. So it was completely understandable that this drove markets down further after the dot-com bubble burst. The last example we'll look at is flash crashes. And there are two of them that we'll look at, one in 1962 and the other one in 1987. Now, what characterizes these flash crashes is they tend to happen fairly quickly, sometimes over a period of hours, sometimes over a period of months. But also, nobody can explain why they happen. People just get scared, and that fear feeds on itself and drives markets down further. There are certain factors which amplify the falls. For example, leverage can force markets to fall further once a sell-off starts, but fortunately they're very short-lived, so these are great buying opportunities. The US Securities and Exchange Commission, the SEC, created a massive report looking at the reasons behind this flash crash, and this is one of the graphs from that report, which is why it looks a little bit retro. This is the Dow Jones average between 1961 and 1962, and this is the crash that we're talking about. Now, another thing that characterizes these flash crashes is they come with a large volume. Large numbers of shares trade hands as people are trying to desperately leave the market. So you can see here at the beginning of June 1962, there was a big spike in share trading volume. Now, the report was hundreds of pages long, and the conclusion was that neither the study, which is this report, nor the New York Stock Exchange has been able to ascertain the precipitating causes of the May 1962 market break. In other words, despite all of the resources they threw at the problem, they just have no idea why it happened. People just got scared. The 1987 flash crash started off on October the 19th, and it started off in the Asian markets. And the effect on the S&P was considerable. There was a huge fall of 20% on the S&P 500 over the space of one day. And that was on Monday the 19th of October, which is now known as Black Monday. And after Asia had crashed, as each market opened, it also crashed. So first there was Europe, and then it was the US. Now, the hallmark of a flash crash is that people don't know what causes it. There are long arguments after it happens about the trigger. One of the standard explanations was that it was triggered by something called program trading. That's when lots of shares are bought and sold simultaneously. There was a product at the time called portfolio insurance, which meant that lots of institutional traders were buying and selling at the same time. So once the selling starts, it would be amplified by these block trading programs. However, this doesn't really stack up because in Asia, there really wasn't much program trading. And of course, that's where the sell-off started. Another explanation was that there was a big storm in London on October the 15th and 16th. And this stopped many traders from getting to work. But this was a localized issue, so it can't have been the cause of a global sell-off. So I don't think that argument holds water either. But one of the good things to come out of that 87 crash was the creation of circuit breakers. And what that means is that if markets sell off by a certain amount, people get a breather when trading stops. People can step back from the markets, calm down, and then trading can resume. Unless it's a really large fall of, say, 20%, when trading can be stopped until the end of the day. So hopefully you can see some analogies with where we are today. But again, the goal is not to scare you. It's to try and help you see that these sales are actually a useful thing, but also to see what might cause them to happen and how long they might last if they do happen. Now, if you do want to learn more about investing, a great way to do that is by signing up for our free weekly market roundup. You'll find a link to do that in the description and beside me. And as always, thank you for listening.